Hello, everybody. This is AK. I'm back. So, last month in January, I published several blog posts which I did not make companion videos for. Right? I just didn't feel like talking, literally talking. But I did share links to those blog posts in my YouTube community, right? And ask for anyone, and ask that anyone who's interested go read those blog posts. Just didn't feel like making videos. And this morning I published another blog post, and I was thinking of not making a video for it too. But then I have some time before I go out, and I say, oh well, let's try making a video. So if this video turns out well, it'll go live, or otherwise I'll just delete it and share a link to that blog post. So anyway, crossing fingers. So today I publish a blog post on DBS and its share price. And that's because the share price has gone up so much, and people were wondering whether it's a good time to sell. And I've said before that I was looking at selling some of my investment in DBS at 2 times book value. So this morning's blog post looked at this in greater detail. So let's look back many months before. I said interest rates are likely to stay higher for longer, right? And higher for longer interest rates are good for the banks, for DBS, OCBC, and UOB. It means that they would be able to generate higher net interest income for a longer time, right? So in their latest results, DBS say that they expect net interest income to come in slightly higher this year due to this environment where interest rates are staying higher for longer, right? And this is a change from their expectation for net interest income to stay flat or weaken year on year because of the rate cuts by the Fed. And if you have been following the news, you know that Mr. Market was initially expecting like 5 or 6 rate cuts in 2025, and that has been scaled back to only 2, right? Expectation for only 2 rate cuts this year. And Mr. Piyush Gupta said in an interview that they might actually happen only towards the end of 2025. So not only has the number of rate cuts expected been reduced drastically, the time when the rate cuts might happen has been pushed back all the way to end of 2025. So this means more good times for DBS, OCBC, and UOB, and not such great time for the REITs, Singapore REITs, right? So people who preempted and thought that the REITs would be doing much better because of the many rate cuts that were expected, and they jumped big time into the REITs bandwagon, they have to wait a bit more, right, before things improve, because the REITs are likely to underperform or stay in the doldrums for a lot longer. And I keep saying that we should demand more from REITs if we want to invest in them, and I've used examples and I've explained why in my videos. And if you are interested, if you have not seen that video yet, you might want to go and take a look or read the blog post. I think I have both on that topic about how we should demand more from REITs if we want to invest in them today. So now the Fed is expected to keep interest rate on hold, right? And It's good for DBS, OCBC, and UOB, especially when we think of how strong their wealth management business has become, and they are receiving a lot more income from fees. So now they have all engines of growth firing, right? And we could see earnings surprising to the upside. And shareholders should also be rewarded a lot more. The banks have a track record of being very fair when it comes to rewarding shareholders. And DBS has already announced a higher final dividend of 60 cents per share, which is about 10% higher than the 54 cents per share a year ago. So we're receiving higher dividends. On top of this, they are going to introduce 15 cents per share per quarter payout over the next 2 years. So in the next 2 years, you're going to get an additional 50 cents per share per quarter. And this is a return of capital because the bank has a lot of excess capital. And this will bring the payout per quarter to 75 cents per share, assuming that regular dividend does not increase further, which is unlikely. So Mr. Market likes this a lot, and the share price of DBS went a lot higher, right? And like I've said, I've mentioned before that 2 times book value was something I was looking at, that maybe I would be trimming my position in DBS. But with this recent development, this has to change, right? We're talking about 15 cents per quarter per share increase in payout. And this basically means a 25% increase per quarter, right, from 60 cents to 75 cents per share per quarter. And I'll be giving up a lot in terms of passive income by selling now, right? And because I expect the share price to stay higher for longer, or else being equal, it could be a long wait before I get to buy in again. So while waiting, you have to remember, while waiting, the NAV of DBS, the net asset value of DBS, will continue to climb higher, right? And because they're also doing share buybacks, basically the book value per share, the net asset value per share, is also going to go a lot higher, right? you start to see the picture once that sinks in. And of course, some people might say that, DBS returning capital over the next 2 years to shareholders means that DBS NAV, the book value, would be impacted. But we must remember, and I would highlight, that it is only 15 cents per share per quarter capital return. And this would be more than covered by retained earnings, which means NAV of DBS would still be growing. So just to crunch some numbers very quickly, a 50% payout, roughly 50% payout, you get 60 cents dividend per share. So you still have about roughly 60 cents per share retained earnings per quarter. And DBS is only paying out an additional 15 cents per share per quarter. So the bank is still growing its book value by 45 cents per share per quarter, right? So for those of us who are using book value as a guide as to when to sell, the target price to sell would only move higher and higher over time, right? And so given the current situation, the share price has more room to move higher, right? Even with this additional 15 cents per quarter payout. Now, to put this in perspective, JP Morgan is now trading at about 2.3 times book value. And could we see DBS trading at 2.3 times book value in future? It could happen. But even if we were to keep it at 2 times book value, in terms of dollar value per share, price per share, 2 times book value, that price per share would only go up over time, given the current scenario, right? So now it's back to the drawing board. When to sell DBS? I think the share price has to move up a lot higher, move way ahead of fundamentals, move a lot higher before I'll consider selling, right? And for UOB and OCBC, I expect both banks to surprise to the upside as well, given what we have seen with DBS. It is barring unforeseen circumstances, I know, and what specific plans the banks might have for their excess capital. But their earnings would have grown, I'm very sure. And their excess capital, well, that is the only wild card. What are they going to do with the excess capital? How are they going to generate value for shareholders? Are they going to do share buybacks only, or will they give out some of that as dividends to shareholders? Right? So, like I've said, investing in DBS, OCBC, and UOB, and increasing the size of those investments and staying invested has been very rewarding for me, and I expect it to continue to be rewarding. Right? So if AK can talk to himself, so can you. Bye bye.